I was on a call the other day with a brand new multifamily investor, and they asked me, what should I be looking at when I'm presented with a brand new investment opportunity? I thought this would make a great video, so here we are, and there are 3 things that you must consider when you're reviewing a new investment opportunity. So make sure you hit the subscribe button right now so you don't miss more videos about building wealth through multifamily real estate. And if you don't know me, I'm Seth Ferguson, a 13-year real estate veteran, host of a real estate TV show, host of a real estate investment podcast, and I'm also the author of the real estate book, Sell for More. So let's get right into it and talk about what I'm calling the investment trifecta. And I'm calling it the investment trifecta because I haven't come up with a fancier name. So this is what we are running with. And like I said, there are 3 things. And the person on the call was a brand new investor looking at getting into multifamily because of all the benefits that multifamily provides, the strong cash flow, the stability, the upside, the tax benefits, and they were really interested, but they weren't really sure what they should be looking at when they're reviewing a new deal. And these are 3 things that I think everybody should be keeping in mind, foremost in their mind when they're reviewing potential investment opportunities. So I'm going to go in reverse order and start with number 3 on the list, and that is your return in the investment. Now, you might be thinking, Seth, my returns are the most important thing. Well, I would argue no, and there's 2 things above this, 2 points. But you should always be considering your return. Is your money working the hardest it can be in that specific asset? Or is there another investment opportunity where you can get a better return? In multifamily, traditionally, we have very strong returns. We have very strong cash flow. And then we have our capital events. And I'll put a link right up here to a video I did explaining all about capital events. Your distributions, the cash flow is like breadcrumbs, and then capital events are your big payday. And it's also important to keep in mind how the returns are being paid. Is it just a lump sum at the very end based on the work you've put in, or is there cash flow along the way? All this comes into the return metric, if you want to call it, this part of the trifecta. You always want to be making sure that the returns are hitting what you consider to be good in your investment profile, and everybody is going to be different. And this kind of leads into number 2, which is the risk involved. Now, the risk and returns are very tied together because the higher the risk, the higher the return should be, and vice versa. The lower the risk and the lower the returns you'll be looking at getting. So let's say we're looking at a property and it's unstabilized. It has a big vacancy problem. It's not cash flow positive, and you're investing in that opportunity. The risk is certainly a whole lot greater. It's not producing, it's not cash flow positive, and it's not occupied. The type of debt you're going to be getting on that property is going to be more expensive, and there's all sorts of risk factors at play there. In order for you as an investor to actually place your money in that type of deal, you're going to be wanting a much higher return in exchange for you taking that additional risk. But then let's say you're acquiring a cash or investing in a cash flow stabilized property with a strong cash flow. It's got a good business plan, a good value add plan for increasing rents, either through some renovation or operational efficiencies. The return will not be as high, but you have to think about it. Is it really worth risking your capital, investing it in a riskier deal for what, maybe 5 points of a potential return? Keep in mind, it's one thing to look at a spreadsheet, it's quite another thing to actually make it happen in real life. And you always have to be conscious of that fact when you are reviewing potential deals. And you always have to make sure that the underwriting in the marketing package is accurate and realistic. So this is one thing. A lot of beginner investors, I don't think a lot of them really consider the risk and reward or risk and return. You may see some big numbers being advertised in a marketing package for one deal that's riskier, it's unstabilized. But again, I think if you talk with a lot of professional investors, they'll tell you, well, you would rather hit singles all day, to use a baseball analogy, than hit a home run one time. You're always going to get on base hitting singles, and that's what you should be aiming for, because not every deal is going to turn out to be the home run, and you should not expect that. So we've talked about returns. how you're getting the return, if the return's fitting your investor profile and your goals, the risk associated, the risk you're taking in order to get those returns. Does that fit within your investor profile? Are you unnecessarily risking your capital for a couple extra points? If so, I would probably steer you towards a more stable investment that's cash flow positive. But what is the most important thing an investor should be considering when looking at an investment opportunity? It's time. Time trumps risk. Time trumps return. Why? Because time is finite. We all have a limited amount of time on this planet. We don't know when our time will be up, but time is our most valuable resource. And the wealthiest investors that I speak with, it all comes back to time. Return, we can always make more money with our capital. We can choose which risk profile, what investments we put our capital into. But when it comes to time, once we waste it, it's not coming back. We can always make more money, but we can't get back time. So when you're looking at an investment opportunity, how much time do you have to put into that investment opportunity if you're on the active side? Or would it actually be better for you to participate on the passive side and get your time back in exchange for maybe less return? A lot of professional investors will tell you that they would much rather take a lesser return on a deal in exchange for getting their time back, for not participating actively, for being on the passive side where they don't have to do anything during the deal process. They just invest their capital and then they're free to do whatever they want, and they get their distribution checks on a monthly or quarterly basis. Time, I think, is the most important thing to keep in mind. And a lot of beginner investors, because I do lots of calls with people every week, I don't think time gets enough credit when we are assessing deals. And time makes up the most important part in the investment trifecta, the real estate trifecta. I'll have to come up with some sort of acronym for this. I'll probably end up putting this in my book that's coming out pretty soon. So just to recap, we look at return, and then coupled with return is the risk. And are we getting the appropriate return in exchange for the risk we're taking with our capital placement? And then time. Are we using our time most effectively? Are we protecting our time? Are we actually giving up too much of our time in exchange for a return? Or are we getting an appropriate return to get back? Or are we willing to take an appropriate return in order to save our time? So hopefully this really helps you out, especially if you're a brand new investor, in giving you some clarity into what you should be looking at when assessing a new investment opportunity. And if you are interested in learning more about multifamily real estate, join my free Facebook group. The link's right down below. It's a great group of people, always willing to help out. And if you are an accredited investor, set up a free 20-minute phone call with me at callseth.com, and my team will definitely help you out. And if you like this video, if you found this useful, hit the like button, leave a comment, let me know what you think. It really helps out the channel. And until next time, happy investing.